It's been a rough year for the streaming stocks. Netflix, the worst of the bunch, down 67% year to date, and it's set to report earnings tomorrow after the bell. The second worst is Warner Brothers Discovery, down about 40%. Paramount Global, down about 18%. And then there's Disney. Now, it's more than a streaming company, but it's also down nearly 40% this year. It's the worst performer on the Dow and on pace for its worst year since 2001. The stock is trading lower than it was during the March 2020 COVID sell-off. So is it time to buy Disney? Joining me now, a Disney bull, Cowen the media analyst at RBC Capital Markets, and a Disney bear, Doug Creutz, senior research analyst at Cowen. Welcome to you both. And Doug, apologies for having to call you the bear here, but neutral is about the best we can do. And the stock's performance speaks for itself. So, Cowen, let me start with you. What is the upside on Disney, and why do you think the stock has been lagging so much?
Yeah, of course. Thanks for having me. And clearly, softer than expected results from Netflix last quarter have continued to weigh on sentiment on streaming stocks overall as investors question the long-term attractiveness or even viability of the streaming video business model. And this clearly hits Disney, who has gone all in on its streaming efforts. That being said, I think it's important to keep in mind that Disney Plus is at a far different stage of its growth profile than Netflix. Think about consensus estimates having Netflix growing revenue at about 5% through 2025, but about 20% for Disney's direct-to-consumer portfolio. Disney Plus is still expanding globally. It's still ramping its content portfolio and has scope to flex its pricing power going forward as well. So ultimately, not every streaming service is created equally, and I think Disney still warrants a premium valuation that rewards its strong growth outlook that we're just not seeing today with the stock at $100.
Yeah, you have a 176 price target. As you said, we're just under 100 right now, so significant upside, almost a double. Doug, do you think this is all just about streaming being re-rated this year, or is there something bigger going on with Disney that's problematic?
Well, I think, there's a debate going in the market now whether we're headed into recession or not. And if we are, that's going to impact Disney's parks business pretty significantly. It's always had a lot of sensitivity to the economy. The parks business had been very strong for Disney over the last year since reopening, a big positive surprise, but a recession could undercut that very quickly. They've done well by raising price, and it's not clear how well that can stick if we do go into a recession.
Go ahead.
I think the other issue is that, they've invested an enormous amount of money in their streaming ambitions. And I think there's a question of whether they've invested it well. They certainly have a lot of great content. But I think with the issues that Netflix has had, it's caused everybody to reevaluate sort of the TAM, the total addressable market of the streaming business. And perhaps Disney needs to rethink some of their strategy as a result of that.
Are you speaking specifically about Fox?
Fox is certainly part of it, yes. We tend to view Fox as a mistake by them. Disney's great at family brand content, and Fox essentially diluted their content pool with a lot of content that's fine, but it's not really what they're known for or what they're good at. I think Disney Plus could have succeeded just as well without Fox.